Welcome back to 15 Minutes of Finance. I'm Brandon West, a CPA, and I'm going to help you keep more of your money. Today, we're talking about how costly financial mistakes can be early on in your career, how to avoid them, and 3 of the worst pieces of financial knowledge that I've heard spouted recently, and we're going to call those out. I'm in a great mood today. For those of you who maybe are wondering why someone who's a partner in an advisory firm would be in a great mood with the last couple weeks and another bad day of the market, for me as a CPA, tax season's over. So I'm going from 60, 70-hour work weeks to 25, 30-hour work weeks here for a couple weeks. That's super exciting. And something I love about my job is that my job getting less busy falls at the same time as the NBA playoffs starting. So for those of my basketball fans out there, it's a great time to be a basketball fan. It's the playoffs. It's exciting. We had a great first round. So I'm in a great mood, and I'm ready to talk about bad things to do with your money while I'm in this great mood, all right? So we're going to talk about some financial pitfalls. We're going to talk about how costly financial pitfalls can be. And we're going to talk about how to avoid them and what some particularly bad strategies are to make sure you're not implementing these, you're not pursuing these, and help you avoid bad financial knowledge as you move forward. I think this is going to be a great episode. I think it's going to be efficient and compact. I'm really going to try to stay under the 15 minutes, and I think this is going to be a good one. I think it's going to be very, very compact, efficient. I've already said that twice, so I'm already not true when I say that, but I'm still optimistic we're going to do this. So let's talk about financial mistakes and why they're so costly. And that comes back to one principle. It's probably the most single fundamental principle in investing, and that is time value of money. And what that means is money is more valuable today than it is tomorrow. Okay, and the way that money compounds and earns interest, the earlier we invest, the more money we're going to have. Okay, so why is financial mistakes? Why are financial mistakes so costly? Okay, and that's because based on the time value of money, based on the way principal compounds and compounds and compounds year after year, if you make mistakes early on in your financial journey, those mistakes can have a very, very detrimental effect long term because you have less money compounding for many, many years. So we're going to talk about a couple different scenarios here. And basically, we're just going to look at what if you have $10,000. If you invest it, we're going to say you're 30 years old. So we're not assuming some situation that a lot of people are not in. If you're 12 years old and have $10,000, we're talking about a 30-year-old whose sole investable assets are $10,000 at 30 years old. That's doable for a lot of people. How can a mistake or a great move change their financial outcome? Okay, so at a 10% rate of return with $10,000 invested for 35 years, no other investments, just that starting amount, we end when we're 65, 35 years, we retire, we've got $281,000. Okay, so right off the bat, that's super cool. We constantly emphasize how great time value of money is. If you're anybody out there who's new to investing, who doesn't invest as much as they know they should, be encouraged. Money makes you money. So $10,000, 35 years later is $281,000. That's awesome. But let's talk about what happens if you make a bad decision. Okay, you put some of this money in a really risky investment. You take advice from social media and you lose money on cryptocurrency. You make some sort of move that is not prudent and you lose 10% of your investments at 30. Okay, now you start with $9,000. At 65 years old, you've now got $253,000. Okay, so a $1,000 mistake compounds into being a $28,000 mistake. What if the mistake was worse? Okay? What if the mistake was right now? All right? So year to date, the S&P 500 is down 12.73% from January 1st. Okay, it's down a little bit more in the last couple months because that first maybe 20-ish days of January, it continued to rise a little bit, and then it's gone down a little bit more. But from January 1st to now, okay, so less than 4 months, we're down a total of 12.73%. Obviously, that sucks, okay? Nobody likes losing over 10% of their portfolio in the market in less than a quarter of time. Okay, that completely sucks, okay? So if you're down to $8,723, which is what you would be if you were in the market on January 1st and then you sold now because you panicked and you said, I don't like the way things are going. I don't like the way Trump's doing things. I want to get out of the market. I'm not willing to weather the storm, and you sell at the bottom. Now, we don't know if we're at the bottom, but you sell on the way down, let's say. Hindsight will tell us if we're at the bottom or not. You sell on the way down. You've got $8,723 invested. It's only $245,000. That's great. You're still invested, right? Now, I think we all agree that we'd much rather be at $281,000 than $245,000. It's almost a $1,200 mistake becomes almost a $40,000 mistake over the course of our investable, lifespan of 30 to 65 years old. Okay, so those are some numbers. And now the last thing we're going to look at is what happens if you make a really great move? What happens if an investor advises something really smart for you? What if you make one really great investment that pans off a little bit better than the rest and you're at $10,500 instead of $10,000 for 35 years? You end up with $295,000. So a $500 benefit, that could even just be being more disciplined. Maybe you put in an extra $500 from your neighbor who invested just $10,000. That $500 is a $14,000 boon for your investable assets. Okay, so why do I say this? Why am I talking about this? It is imperative to constantly remind yourself when the market is tumultuous, when it is down, when it sucks, when the news articles that you're reading are doom and gloom, they're not positive, they don't have a great outlook. You have to remind yourself of two things. One, you're not retired yet, okay? Now, if you are retired, you probably shouldn't have been 100% exposed to the market, right? And hopefully you're working with an advisor, or maybe soon you will work with an advisor that can help you manage your risk tolerance. But for any investors under 50 out there that are listening, which I do believe is the majority of our audience. It spans a wide range of ages, but most people are under 50 to 55. If you've got still 5 to 7 years of your working life, your money's not gone. You own the same thing you owned prior to the downturn. It's just people say it's worth less, but it's the same thing. Okay, the Palantir stock you owned 3 months ago is the same Palantir stock that you own today. People just say that it's worth less now. They might be right, they might not, but you own the same thing. So remember, you're not retired yet. You can't touch this money yet. It doesn't matter what your portfolio says. Don't sell your own stock at a discount unless you absolutely need the money in an emergency. And then obviously, things like health, that comes first and foremost, right? Number two, we're still higher than we were a year ago, 2 years ago, right? The last 2 years, we were up, I think it's 26 and 24%. We're down almost 13% now. We're still higher than we were in 2023, okay? So you've always got to put these bad days into perspective. All your money's not gone. You don't need it yet. By all accounts, it will likely rebound, and you still have more money than you did 2 years ago. So that should encourage you more than anything else to weather the storm, because if you didn't weather the last storm, you'd have less money. And if you didn't weather the storm before that, you'd have less money. And every storm we've ever weathered has taught you the lesson that it will rebound. So you need to listen to all of those past mistakes that people have made and don't make the mistake now, okay? So that's the importance. If you get down 12.73% and you sell your own stock at a discount, okay? $1,273 is a 37, I think I'm doing the math right in my head right now, is a $37,000 mistake. If you got $100,000, do that math of how much that money's going to cost you, okay? With just $10,000, just that 12.73% is a $37,000 mistake. If you've got millions of dollars, if you've got tens of thousands, you've got hundreds of thousands, these are costly mistakes. Do not get scared now and make a compounding mistake that will really, really cost you building wealth. Invest early, invest often. Don't sell early and sell often, all right? That's the distinction. All right, let's talk about 3 mistakes that I see constantly peddled by the toxicity that is social media investing, where guess what? Financial planner, it's not a regulated term. All right. Now, there's other countries, by the way. Fun fact, fun little tangent here. I was reading through some Reddit threads of just general financial knowledge and people asking what's the difference between a CFP versus a financial advisor. And there's some countries where it's exactly different. So just fun fact, a lot of people are commenting that in Canada, advisor is a completely unregulated term and planner is. So a planner, you're actually getting advice from someone who has some form of credentials. That's the opposite here in the US, all right? Anybody can call themselves a financial planner, okay? Let me tell you something. I bought this mic on Amazon. Everybody else can buy a mic on Amazon. Just because someone is on Instagram with a mic in their hands calling themselves a financial planner, that means nothing. My mom could do all of those things and start giving financial advice. I would strongly recommend not listening to that advice because she is not a financial advisor. She's not a fiduciary, and she doesn't work in the profession. She just gives advice with no backlash, no consequence because she's not regulated, which means there's nobody that can hold them accountable if these people make horrible, horrible investment advice and guidance. And that's a lot of times what they do. So, number 1, and this is, you'll never guess, someone selling their own financial course. Whoa, bad advice from someone selling something? Crazy. This advice, and I've seen this a lot. Hey, investing in 401ks, maxing your IRAs, that's not good enough anymore. You need new strategies. Read my book. Let's put that to the test. Is maxing your 401k enough anymore? For those of you who don't know the laws, you can put $23,500 each year into your 401k. No matter how much you make, you can always elect to defer up to the maximum of your salary as long as you're in a 401k plan at your work. It doesn't matter how much your employer match. You can always put the maximum elective deferral, okay? So I'm going to assume that you start at 25. You don't have a single job, a single dollar saved until you're 25 years old. And then you retire at 65. And I'm going to only assume you earn 7% interest, significantly below the average S&P 500 over the course of its lifetime. But I'm going to assume conservative, you only get 7% on your investments. And you max it every single year. And you never get an employer match. Nobody gives you money. You never get a match. You never have an IRA. Nothing. The only thing you do is max your 401k for your working life. You have $4.7 million, okay? So that person selling you a book is giving you bad advice on the fear that what you're doing isn't good enough. Times have changed. The traditional knowledge doesn't apply to you anymore. If $4.7 million plus Social Security income would get you through your retirement, congrats. You're with the rest of every single working American where maxing your 401k is absolutely enough. Don't get alternative, fancy, creative advice from people who aren't professionals and don't know what the heck they are talking about. All right, number 2, bad financial advice. Get into real estate early. Now, I'm not an anti-real estate investor, but there is so much social media, internet, even there's a lot of kind of networking pressure of real estate people. Of, have you bought a house? Have you considered buying a house? You can get into real estate investing. You can buy partial shares. And there's all these people saying, I bought my first rental at 22 years old. I now have an empire of rentals. Here's why you shouldn't do that. Real estate is a highly leveraged asset, okay? That means, yes, you are paying off over time an asset that theoretically is gaining value over time. That's awesome. You're also earning some form of passive income because you're being given rental income, which sort of serves like getting dividends on a stock investment. So there's an income component and there's the investment equity component. Awesome. But there's debt to it. If you own Microsoft, okay, 2 shares of Microsoft, and you bought each one for $100. I have no idea off the top of my head what the Microsoft stock is worth. And they go to zero. Guess how much you lose? $200. If you buy a home on a mortgage that's $600,000, you don't just lose the $100,000 down payment you made. That home could go to $300,000. Guess what? You still have a $600,000 mortgage. I would strongly encourage you to not get like bro hyped by these investment bros talking about how you can buy one rental each year and then use the equity from that to get a HELOC and buy your next rental. And by 25, you can have 10 rental properties. If you do that before a financial crash, a financial downturn, you could bankrupt yourself to oblivion. Real estate, excellent investment, but it should only be made by people who have some level of cushion and safety so that they aren't leveraged with debt that they can't pay to weather a potential storm. Stocks, you don't have to worry about the storm. You're as long as you're not buying stocks on debt, you're fine. The most you can do is lose your money or your money goes down, and then by all accounts, it'll probably go back up. Real estate is a debt leveraged investment, and it is incredibly risky. Do not get caught in a situation where you don't know how you're going to pay your mortgage because you got hyped into buying a 5% down payment rental unit at 23 years old, okay? Number 3, and this is going to make some people mad, and that's my favorite part about it. I'm going to say it anyways. Hey, get into Xcoin, all right? These are for all my crypto bros out there. Now look, crypto is not a bad investment. It's not a regulated currency, so James and I can't give, advice about buying or selling certain cryptocurrencies. We're not going to advise you on whether it's good or bad or which ones to buy or which ones to sell. What I'll say is this: if you hear about crypto from somebody else, don't buy it. Okay. I know a lot of people who have done well on crypto. Props to you. They did awesome. A lot of them did a lot of research into it. Does that mean they were even still 100% guaranteed? Of course not. But if you're being told to buy crypto from somebody, it is an incredibly complex investment. There are millions of random, what are referred to as meme coins. And let's be honest, it's gambling. Okay. These meme coins, often, I'm not going to anger all the crypto bros and say crypto has no use, but a lot of these meme coins have no intrinsic value. They're just hyped up investments that are only valuable because people keep buying them and someone's going to get left holding the bag and lose their money. So if you're being told to buy crypto, that means you don't know enough about it. Stay out of it. One thing that's interesting to me that I will say is it does feel like to me, and if you're a crypto expert and you want to come on the show as a guest, feel free to call me out. Let us know. We'd love to have you on, all right? We're starting to set up our guest lineup right now. Let me know. Call me out. Maybe I'm full of crap, all right? But this is what's interesting to me about crypto and my understanding. The crypto investors were correct in their investment decision at large by almost sheer luck. And what I mean by that is crypto has performed well, but for almost exactly the opposite reasons that it was invested in the 2010s, going into this resurgence of crypto, okay? Because what we were told is, well, the dollar's going down. The U.S. is $30 trillion in debt. The crypto has a hard cap on it. It's unregulated, and it's, it has intrinsic value with the way that the blockchain technology will be integrated into the online market in the coming years. Why has crypto actually exploded in value? Because the Trump administration from the White House has made announcements that it might be regulated. It has blown up with the explosion of meme coins that are now completely, separated from the hard cap on total production that Bitcoin was initially touting as a major advantage of the coin. All right. So yes, crypto exploded, and the people who were in crypto early, a lot of them made a ton of money, but they were wrong. It is not gaining value because it's unregulated and hard capped. It's gaining value because it actually got a bunch of talk about oversight, about potentially integrate. Like when Trump made the tweet that said, we are exploring having cryptocurrency reserves in the Federal Reserve, the value exploded. So the value directly rose in regards to it maybe being regulated and integrated with the government. Okay, so they were right about the value, but they were wrong with their reasoning. A lot of times when you're wrong with your reasoning, the result isn't good. So that should tell you how volatile that market is. If you want to get in it, awesome. My advice is if you're being told, hey bro, buy X coin, you don't know enough about it, ignore their advice. invest in index funds, and you'll thank me when you're 65 and you have millions of dollars and you never had to stress about these high ups and downs as the market went, extremely volatile, and you saw your value go up and down 50%, 20 times over your lifetime. All right. Well, I'm looking at the time, guys, and it's not 15, so I guess once again I am a liar. But we're in pretty good shape. We've done a lot longer episodes, so thanks for coming along on this episode. Look, the bottom line is, don't panic, don't sell off at a discount, weather the storm, and be very, very, very wary of non-traditional, creative, social media hyped up advice. It oftentimes leads to financial ruins, and we see with actual calculations, we see the math of bad decisions and how those bad decisions can hurt your investment by tens or hundreds of thousands of dollars in the long term. So make good, prudent decisions that come from wisdom of experts in the field, and you'll be fine. Take a deep breath. You're gonna be okay. If you do this, invest early, invest often. See you next time.